Google reported earnings recently and the stock climbed about 3%, but shares are still down 13% year to date, giving the company a market value just over $2 trillion. With $95 billion of cash on the balance sheet, $51 billion of investments and $11 billion of debt, the company's enterprise value is $1.92 trillion. Google's revenue over the last 12 months comes to $360 billion with $111 billion of net income, $136 billion of ebitda, and $75 billion of free cash flow. So the company is now valued at just under 19 times earnings, 14 times ebitda, and 26 times free cash flow. 19 times earnings for a quality business like Google seems too cheap, and this was another impressive quarter. YouTube revenues grew 10% year over year to $8.9 billion. Subscriptions grew 19% to $10.4 billion, and Google Cloud grew an impressive 28% to $12.3 billion. That's faster growth than AWS, but not quite as fast as Microsoft Azure. Most importantly, revenue from Google Search increased to over $50 billion, undermining the argument that ChatGPT is disrupting Google's largest business. AI tools may one day pose a threat to Google Search, but right now that isn't reflected in the numbers. And there were other highlights too. Google's Gemini was recognized as the #1 AI model in April. Waymo continues to scale, and Google management said its custom TPU chip was leading to 10x efficiency gains. That said, there are some things investors might want to consider. The first relates to earnings. Google's Q1 net income was a record, but it was also boosted by an $8 billion paper gain from the firm's investment in SpaceX. Account for that, and earnings were roughly flat on the previous quarter. Meanwhile, some investors are beginning to question whether Google's large investments in AI are being adequately accounted for. In the first quarter, Google's property and equipment spend went up by $5 billion year over year, but depreciation charges increased by only $1 billion. That could be an issue because if depreciation charges don't adequately cover the life of an asset, they artificially boost earnings. Large capital investment explains why Google's net income is significantly higher than its free cash flow, and as shown in the chart, the gap continues to widen. In other words, if Google's AI investments don't pay off, then the stock isn't as cheap as it looks. Even so, when you consider Google's dominant position, its strong financials, and the billions of people that use Google products and services on a daily basis, it remains very difficult to bet against this company. The business Google has many parts and they're all moving in the right direction. That's why I continue to give the stock a bullish rating. But these are my personal opinions, not financial advice, and I hold no position in Google stock. For more investing videos, make sure to join my newsletter at 3minutebreakdowns.com. Thank you for watching.